there, ever wondered how the super rich like Elon Musk, Jeff Bezos, or Warren Buffett pay way less in taxes than you'd expect? Like, how does a billionaire sometimes pay less tax than a teacher or a nurse? Well, today, we're gonna break it all down, not from a shady or sketchy angle, but the legal, IRS-approved ways rich people reduce their taxes, and how some of those strategies might even work for you too. So grab your coffee or your favorite beverage, and let's talk tax loopholes, capital gains, depreciation, offshore accounts, and even how giving money away can lower your tax bill. Seriously, let's make this fun, real, and most importantly understandable. Ready? Let's go. Why the rich pay less. So here's the thing, rich people don't usually earn money the same way most of us do. Most people earn income like your paycheck, and that gets taxed through your employer, right? But the wealthy, they make most of their money through things like investments, real estate, businesses, stock options. And here's the key, investment income is taxed differently than regular income. Example, capital gains via salary. Let's say you work a 9 to 5 and earn $100,000 a year. That income could be taxed at up to 37%. But if a billionaire sells $100,000 worth of stock after holding it for a year, that's considered a long-term capital gain and is taxed at 15% or 20% depending on income level. See the difference? Same amount of money, way less tax. So, Step 1 in the tax game. Earn like the rich do. Capital gains, the secret sauce. What are capital gains? Capital gains happen when you buy something like stock or property, hold it, and then sell it for more than you paid. If you hold it for more than a year, that's a long-term capital gain. The tax rate? 15% or 20%, depending on how much you earn. Let's put that into a real-world example. Example, Warren Buffett. Warren Buffett is worth over $100 billion, but he's said before that his secretary pays a higher tax rate than he does. Why? Because Buffett pays himself a small salary, but most of his money comes from investments, aka capital gains and dividends, which are taxed at lower rates than his secretary's paycheck. Depreciation, the real estate loophole. Now, it's talk about real estate. This is one of the most powerful tools the wealthy use to avoid taxes legally. What is depreciation? Depreciation is basically the IRS saying, your building is getting older every year, so we'll let you write off part of its value, even if it's going up in market price. Yes, it sounds weird, but it's totally legal. Let's say you buy a rental property for $500,000, even if it goes up in value. Over time, the IRS lets you depreciate it over 27.5 years, claiming a loss each year on your taxes. That paper loss can offset your actual rental income. Example, Donald Trump. Whether you love him or hate him, Trump has famously used real estate depreciation to pay little or even no federal income tax in some years. Depreciation, combined with other deductions and losses, helps reduce what he owes to the IRS, even if his properties are cash flow positive. Tax loss harvesting, turning losses into wins. Here's a slick trick the rich use with investments. Tax loss harvesting. Let's say you buy stock in company for $10,000 and it drops to $7,000. Ouch. But if you sell that stock, you can claim a $3,000 capital loss. That loss can offset your capital gains from other stocks you sold for. Profit. It's like playing offense and defense with your investments. Fun fact, you can even carry unused losses forward into future years. So, if you lose big in one year, you can still use those losses later to reduce taxes on gains down the line. Offshore accounts, legal or shady? Now, we've all heard about the rich stashing money in the Cayman Islands or Switzerland, right? So here's the real deal. Having an offshore account isn't illegal. Hiding income from the IRS? That is. But the ultra-wealthy and big corporations use legal structures to defer or reduce taxes by keeping money overseas in low-tax jurisdictions. Example, Apple. Apple had over $250 billion overseas, at one point legally parked in countries with lower corporate tax rates. They weren't hiding the money, they were just using the tax code to delay paying US taxes on foreign profits. Eventually, the US changed the rules to 2017 Tax Cuts and Jobs Act. But for years, that strategy saved companies and rich shareholders billions. Trust funds and estate planning. Let's demystify trust funds for a second. A trust is a legal structure that holds assets like money, stocks, or property for someone's benefit. The wealthy use irrevocable trusts, grantor retained annuity trusts, and dynasty trusts to pass on wealth without triggering massive estate taxes. Example: Walton Family Walmart. The heirs of Walmart founder Sam Walton have used trusts for decades to pass on billions without paying the full estate tax rates. By placing shares into these trusts, they avoid big chunks of estate taxes and still control the assets indirectly. Charitable donations. Give to save. Charitable giving is another big way the wealthy reduce their taxable income while still doing good. When a billionaire donates millions to a foundation or charity, they can deduct that donation, sometimes offsetting millions in taxes owed. But wait, it gets better. They often set up private foundations, where they stay in control of how the money is spent. Think of it like putting money into a family-run charity that you still manage. Example: Bill and Melinda Gates Foundation. Bill Gates has donated billions and received charitable deductions along the way. But because it's in a private foundation, the family still helps decide where the money goes. So yes, they're giving but also saving millions in taxes. Example: Bill and Melinda Gates Foundation. Bill Gates has donated billions and received charitable deductions along the way. But because it's in a private foundation, the family still helps decide where the money goes. So yes, they're giving but also saving millions in taxes. What you can do? Okay, so you're probably not sitting on billions in stock or property, right? But here's the good news. Some of these strategies can still work for regular people. 1. Use tax-advantaged accounts. 401k and IRA accounts let you defer or avoid taxes on retirement savings. Roth IRAs grow tax-free. That's capital gains magic. 2. Invest for the long term. Hold investments for over a year to qualify for lower capital gains tax. Rebalance once a year carefully to avoid triggering short-term gains. 3. Try tax loss harvesting. If you invest through platforms like Robinhood, Fidelity, or Wealthfront, look into selling your losing investments to offset gains. Just watch out for the wash sale rule. Don't buy the same stock within 30 days. 4. Own real estate. Learn about depreciation. Even with a small rental property, you can write off depreciation and lower your taxable rental income. 5. Donate smart. Even small donations can add up. Keep records and claim them during tax season. Look into donor-advised funds, a mini version of a private foundation. So, here's the big takeaway. The rich aren't cheating the system, they're just using it really well. And while you may not have billions to move around, some of their strategies are totally legal and available to everyone. Understanding the tax code doesn't have to be scary or just for accountants. The more you know, the more you can save and maybe even build wealth like the rich. If you found this helpful, hit that like button, share it with a friend, and subscribe for more money smart videos like this. And hey, next time you're doing your taxes, remember, the system's not rigged if you know the rules. Thanks for hanging out with me, and I'll see you in the next one.